Hello, everyone, and welcome to our review of Chapter 4, Accounting from MBA Math and More. Now, I know what you're thinking right now. Accounting, oh no, what am I going to do? Why do we have to cover this in such depth? I'm not going to be a CPA, I get all that. But accounting, and in particular, financial accounting and managerial accounting, will be fundamental to the success of your long-term career pursuits. And in the short term, having an awareness of general concepts associated with accounting will be very beneficial to you in your coursework in our MBA program. That's the reason why we spend this time on Chapter 4, Accounting. So think of this slide as this discussion as sort of our executive summary for Chapter 4. Here are the topics that we will cover in this chapter. Number 1, financial accounting basics. Just the basics here. What do we mean by financial accounting? What does accrual accounting really mean conceptually? What are the big 3 financial statements? That kind of thing. All that will be discussed in another separate short video. Then in several short videos, we will go through the basics of each of those financial statements. And they're in green, indicating the close approximation to the green that you really care about, and that is money. We look at the balance sheet, what accounts are listed on them, how do we interpret it, what does it measure? We look at income statements, same basic issues there. The balance sheet is going to show us the firm's holdings at a given point in time and how they're being financed. The income statement will show us profitability. After we generate a certain amount of revenues, what degree of costs were involved to earn those revenues, and after we cover all those costs, all those expenses, were we profitable? That's what the income statement will indicate to us. I think everyone gets the basic intuition underlying an income statement. A little less so when it comes to the statement of cash flow. But at a high level, you can think of the statement of cash flow as showing us the firm's ability on a net basis to generate cash flow from 3 main operating activities. Basically what it's going to do for us, in more detail on this later. But the statement of cash flow will allow for us to connect our profitability from our income statement to changes in our balance sheet. Okay. So think of that first column of topics as referring to financial accounting and financial statements. There's a little bit of managerial accounting discussed in the book too, in this chapter, and this occurs at the very end, and that's what I refer to as managerial accounting. Managerial accounting is very important for your accounting for planning and control course. In that course, you will look at these topics to a much greater detail, but here I just want to focus you on the basics, and that is calculating the contribution margin for a given product or product line, and looking at break-even quantity. That is, how many units must I sell so that I not only cover all of my variable costs, but also my fixed costs. That's an important number to know because that gives you an idea of risk assessment overall. Lastly, we'll have a separate video on conclusions, just a summing up of the chapter topics. And importantly, I will lay out for you specific ties to integrated business topics that are going to come up as the term progresses in this course to really help solidify your knowledge base in terms of covering the gaps of how these topics work in an overall business setting. One last item here on this slide. You can safely ignore pages 221, the section titled Transactions, all the way through page 233. That deals with debits and credits, and while that's really important to CPAs and those that really focus on journal entries and financial accounting, for the typical MBA student, not as important. So I'm not going to hold you accountable for that. So last thing in this executive summary video is, I like to always try to set up motivation here. Why should I care? If I haven't convinced you why you should care so far, hopefully this will grab your attention. Here's a little case study on a very prominent company we've all heard of, and that is Walgreens. Walgreens, a very large, publicly traded, well-capitalized company, high credit rating. Lots of great human capital in that firm, right? Both in finance and accounting. They're still, despite their great employees they have in finance and accounting, they still have issues to resolve when it comes to financial accounting, because financial accounting can be hard. oftentimes we use financial accounting to make forecasts. Take a look at what happened to Walgreens in 2016. This is from the Wall Street Journal, excerpted, paraphrased. $1 billion forecasting error in Walgreens Company's Medicare-related businesses cost the jobs of 2 top executives and alarmed big investors. And what that should tell us is that there's a share price reaction from this, right? A negative one. More on that coming up. At an April board meeting, the CFO, Chief Financial Officer, who's often tasked with managing financial accounting and reporting and also the finance group, he forecast $8.5 billion in fiscal 2016 in their pharmacy unit earnings. So a specific division of Walgreens, $8.5 billion forecast, partly based on contracts to sell drugs under Medicare. Last month, however, and this is not the current period, but at some point during 2016, last month, however, directors got a shock as the CFO suddenly cut that forecast by just $1.1 billion. If you're thinking about that, you know, that's 1.1 over 8.5. That's a 13% drop in forecasts. Okay, so definitely significant. Take a look at the share price reaction for Walgreens. This is a timeline showing us share price changes in Walgreens. And certainly there was more going on in the macro and micro economy during this period of time, but still it's helpful to see these important dates. April 10th is where the CFO made the announcement about $8.5 billion in pharmacy income for fiscal year 2016 expectation. You see the share price, the evolution of the share price from April to July. Not a steady increase, but an increase nonetheless. July 9th, slashed the forecast. Now notice the share price actually dropped a good bit a couple of days beforehand, which indicates some degree of leakage of information. By the time August 4th and August 5th rolled around, the share price had dropped well below where it was before the large increase in pharmacy income for fiscal year 2016, before that earnings guidance was put out there. So this just gives us an idea of what can come from bad financial projections. At the heart of financial projections is financial accounting. So that gives us motivation for learning more about this topic so that we can help avoid issues like this.